Hey, hey, that is a tough act to follow, but we're going to do our best. Thank you for hanging in there. I'm going to jump right in because I know everybody wants to know what SoftBank has to say this morning. Are you
Maybe,
ready?
maybe, maybe,
Maybe.
maybe.
All right, let's start with this one. Multi-billion-dollar funds. They're not as rare as they used to be. It's a little bit like the unicorn thing. Like you used to never see them, and now it seems like you're seeing them all the time. Most recently, $19 billion fund announced by Insight. When you look at the funds that are around the table, there are more and more funds of this type around the table. From a SoftBank perspective, what has that changed around dynamics in terms of your strategies, how you think about the market, and what are those dynamics when you're in a process like now that you do have more company?
Happy to try and answer that. Following the great act you just all had, I would say going back a little bit in history, Vision Fund One, the average check size was somewhere in the 800s. Clearly, that is no longer the case in Vision Fund Two. But one of the advantages that gave the firm was there was a lot of relationship building that went on because even though we had the ability to cut $800 million checks, that was not appropriate for almost every company that we were meeting. But at some stage, they would be. So it was this multi-year relationship building that happened in Vision Fund One, which was actually very beneficial when, like you said, when Vision Fund 2 came along with a little bit of a different strategy, smaller checks, and then there was addition of so many other funds that could deploy the same kind of capital that Vision Fund could do. We had these relationships that were spanned multiple years, and we were to go back to them and re-engage the founders in a more, I would say, non-market mechanism. And what I mean by that is, if I look back to last year, only 10% of the investments we ended up making, or I ended up making, were what I would call market processes. We ended up either preempting, that's the word we use, but that basically led to like 3+ years of relationships leading to a round that was nobody else participated in, nobody else actually bid against. And we were able to do a lot of that. The second part that changed a little bit was Fund 2 brought in more folks who had experience across different life cycles. Myself, I came from early to mid stage, doing late stage, so I had built up a number of relationships with folks like Mark at Upfront here, but also a lot of founders who had seen at the early stages and funded them. And I was now able to come here and raise and help them with their growth rounds. That plus the existing relationships helped us differentiate in a market which is hard to differentiate, frankly speaking. Ultimately, capital is capital, and relationships only go so far. 2021 was like that, I would say. I would say that 2020 is already very different. And I know you have a few questions on that, but that's how we spent last year with a little bit of a different strategy than our peers. I would say we didn't do, and we are still not doing very early deals. We didn't do every deal we came across with a $50 million check. We did do conviction bets. So we did fewer but higher dollar amounts because we were not sort of essentially in a motion with some of our peers, which there's no right or wrong, but that was our strategy, a little bit more fewer but more conviction bets rather than a lot more volume.
Okay, got it. So I guess what I heard is really, the differentiation around relationships, your ability to avoid really these competitive processes, and really having that discipline of not being driven by fear and writing these larger checks. So, got it. Let me turn to, we were talking about fear and emotion. Let me talk then to crossover funds. Obviously, several years ago, traditional venture, we didn't see that, but more and more we've seen that. And, these firms are clearly outfitted to chase yield wherever yield is. And so I guess one of the questions I have as you look at the landscape from your perspective is where do you think these funds will be 18 to 24 months from now? Do you still feel like they will be, investing at the rate and the pace and at the volumes that we've seen, or are you expecting something different because macro, drives them elsewhere as we deal with inflation or war or interest rate increases?
There's war going on? I didn't realize. No, I think, again, stepping back, there was a lot of, I would say, net new crossover funds that came in the last few years. There's traditionally always been crossovers like the Fidelities of the world that basically provide an anchor to the public offering. And that's, I think, been historically, there's a lot of net new that came in. We are definitely seeing already in 2022 that retrenching is happening. And that's been publicly, some of them have come out and publicly said that. Another interesting thing we're seeing is when I first joined SoftBank February of last year, about a year, I had to spend a lot of time defending the reputation of SoftBank in the Valley, of whether you're going to complete deals, whether we're going to leave founders hanging. I will tell you, 12 months in, we have shown to ourselves to be essentially very, very stable and very reliable partners. On the flip side, some of the newer crossovers have had issues in the last few months because things are not the same that were in December on the public markets. And I've been a recipient of essentially retrading by one of the crossovers on one of my companies. And I think a number of examples already are there where they've been folks that have pulled term sheets or changed pricing. That is already an indication that things are not going to be the same as they were. We are also seeing in 2022, at our stage, because we have kept to the later stages, we do some, I would say, it's not every deal we do is not a pre-IPO deal. So we do some deals where it's not, the next step is not an IPO, but we are not going into head-on with early stage firms, which many of you are represented here. We are seeing the crossovers actually tending to go early. So there is a somewhat of not a hole, but there's definitely a vacuum in the market at the later stages that we are starting to see as we get into 2022. We are seeing some of the processes which would have taken 2 weeks in 2021 are now taking 4 to 6 or 4 to 8 weeks, not because anything has fundamentally changed with the companies, but there aren't 6 firms rushing in to give term sheets, which I think that's healthy overall from a market perspective, from doing diligence perspective, being not rushed into things, both for the founders and for us. So I do think, I can't predict the future, but we're already seeing signs that there is retrenching that is happening. And I think they're not going away. Luckily for us, and maybe not for some of you in the audience, they're going earlier, which means that one thing I've heard consistently from my friends who come earlier than me is they're not seeing any kind of slowdown or change in pricing at their stages, while we are seeing that already. Yeah. So that's an interesting dynamic where they're not exiting the market, they're just choosing where to invest a little bit differently given where the public markets are.
Right. Yeah, this is a good segue, obviously. So we do see them going earlier. I think we're also seeing that there are some values that they're finding in the public markets because of the retrenchment since the fall. I guess one of the questions I have as I heard your remarks, which is, there is this vacuum at the later stage, is that, if you're looking at multiples, clearly they've come back, and yet at the same time, we're looking at, S&P, the S&P 500 multiple sitting at 40x, which on the PE multiple, and the question is you look at the last time that you saw those kind of levels, and that was like 1929 and 2000. So then the question I have for you is, SoftBank obviously has a lot of data sets and is thinking hard about the space. Is this a market peak, or is this like a pause and things are going to now head up in a different direction? And like, what are the data sets you're looking at that like give you the conviction that that later stage of the growth is like the place to be right now?
Yeah, look, if I knew where the market was peak, I'd be a public market investor, which I'm not, thankfully so. So I try not to look at the public market. So I was, look, given that I've been doing this for about 18 years and I'm still doing it, I've gone through many peaks and valleys, the 08, 09 as well. And so I've stopped trying to predict where the public markets will be. They obviously reflect multiples, like you said, and also influence our decisions. What we're essentially trying to do is have a different conversation with founders, and I think I classify the kinds of deals we are able to complete and the kinds of deals we're not able to complete in the new year, and it's just based on founder expectations. Some founders have realized that things have changed, and whether you call it multiples or pricing is different, and we are trying to have them not focus on the headline number, because I think the challenge last year was everybody got expected to, I need the billion mark or I'm not going to take money. And there's still a lot of that going on. Our more successful transactions, and we've been very active the last couple of months, so we've not sort of retrenched in that sense. Our discussion is you should just focus on dilution and then figure out what is the quantum of money you want to raise to run your business, and let the headline number be where it lands. Last year, obviously, if you needed 50, you could raise 100. If you needed 100, you could raise 200 because the cost of capital was not expensive. This year, I think the founders we're completing transactions with are taking a hard look at the business and saying, really, what do I need to run the business for the next 24 months? And if I need 75, and I'm not going to raise 150, and I'll take a lower price because my dilution is the same. And I think those class of founders, we are able to complete transactions. I think the pricing is fine both ways, because once they look at the dilution number is actually sometimes better. We just closed a couple of transactions where we started the discussion to where we ended, the pricing was different, but the net dilution was better for founders. And they're like, this is great. And that is a great signal as well, where we're seeing the insiders stepping up in a big time because they view that as attractive as well. So I do think there's just a reset or a slow reset of expectations that is trickling through the private markets. They have not caught up to the public markets, clearly. And there will always be a gap. I think there's going to be a gap, and great companies will have some distance from everybody else in terms of what pricing is. We're still seeing some pricing where I think sounds like the multiples never changed, but they have. And I think some companies will continue getting that. But for vast majority of them, as long as the founder expectations we're able to manage, and I think we have very thoughtful discussions with founders now. I think they're all realizing that, look, let's figure out what's required to run the business and not forget the headline number. I think if you're not focused on the headline number, we can get transactions done, and we're getting them done.
Let me ask, like, when founders are focused on that headline number, then are you seeing like it manifest in different ways, like funky terms coming in, or like things that like maybe in a more buoyant market you wouldn't see a lick pref that was in excess of one? And to what extent are you seeing that come into play?
We have seen some structure coming back. I personally don't do structure. I just want to get to the right number, and structure is always negotiated out at the next round. So you may feel good that you did some structure and you were able to justify a higher price or whatever you want to do. I think we've seen a little bit of that discussion. Give me the same price, but I'll accept some terms. I personally am just not a fan of that. So none of our transactions have changed the terms of what we were doing in 2021. We're trying to keep the same terms because those are the right ways to look at it. What's the business worth, absent all kinds of restrictions on structure.
Okay, well, I think another interesting question, actually, we were talking about the hours that you keep, because having investment committees across 3 continents is challenging for a firm like SoftBank. I think a lot of people in the audience would just be interested. Like we've talked about valuation and dynamics at the table, but what we haven't done is refine the conversation around what are you seeing differently in the Americas versus Europe versus Asia and possibly even LTAM. Could you just share the, like the more regional level of the conversation we just had?
Yeah, so I think one of our most active regions after the US is Europe, and we are seeing similar things happen in Europe as well that we are seeing in the US. I think deal activity continues to be high, but pricing is changing, and it's reflecting the markets. It's interesting, you might have a company that is getting funded in Europe, but you try to understand where they're going to exit. The European markets are not deep, so you're going to exit in the US for the most part. And so you have to take into account what's happening in the US, a public markets perspective, when you fund companies in Europe, because that's the most likely outcome from a public market listing. Strategic outcomes can happen anywhere. That's different. I think while the LATAM fund we have is different than the Vision Fund, there is very robust activity there. I think we're seeing Latin America coming into its own. There's just a lot of models that happen in the US going to LATAM, getting adapted there. So that's very robust activity. We continue to see there. I think I would say that we, at the highest level, haven't seen the same pressure on pricing in LATAM as we've seen in the Americas and the US. I mean, things may change. They're very dynamic. But there's definitely a fair bit of venture activity pouring into the region and continues to do that. And I think the rest of it, whether it's Southeast Asia, China, there is good activity at the early stages, the late stage. Some of it was affected even prior to the market correction by regulatory headwinds in the region. And everybody is just working through what areas are less likely to be affected by regulatory changes and what areas are. And so there is probably a tale of have and have-nots there in terms of some regions, some sectors are getting starved because they're more subject to potential for regulation, and then some are not, some are thriving. We're seeing a number of software and SaaS companies come up in China that are not necessarily subject to regulatory issues.
Yeah, I'm wondering China, this whole kind of lots of different issues floating there, both around kind of China and the US, in some arguments kind of decoupling with China being kind of more interested in building up their capabilities so that they're not so dependent on the West. Just curious, obviously you've been a very, very early investor in China through SoftBank, and you also see the US. How do you see this kind of manifesting, and what does it mean for tech in the US versus China? Or is it not a versus?
Yeah, I don't know if it's a versus. I will tell you, we do see a lot more what I would call deep tech companies being funded or coming up in China than we see in the US from a VC activity perspective. There's a fair bit of activity. Again, I think last year when SPACs were in fashion, we saw a number of deep tech companies being able to exit out of that. Now it's gone down in terms of their exit paths are a little bit more traditional. It takes longer time. We do see a lot more VC activity in the early stages in China on that side. So whether it's semiconductors, whether it's robotics, we see a lot more robust activity on that side.
Okay, thanks. Look, I know I have this question. I'm sure others in the audience will be interested, which is we all have companies in our portfolio that we'd love to show to SoftBank. So the question is, what are some of the spaces where you guys have conviction? What are you looking at, and what are you looking for as people want to show you deals and talk to you about some of the companies that they're engaged in?
Yeah, please send us deal flow, really. I mean, if nothing else comes out of this conversation, please send us deal flow. We are looking for.
Please send them to me first, and then you can have.
The other good news, by the way, that we didn't talk about is, forget about the gloom and doom. I'm so excited. I'm seeing the same great companies I saw last year and for the last 15 years. So great companies are born, whether, whatever the market conditions, they don't really dictate how companies are being founded. And I'm seeing there's no lack of innovation in what I'm seeing. So that's really heartening. There may be other parameters that change. But on our side, one of the big differences between Fund 1 and Fund 2 is we are far more diversified in the sectors we look at. I think fund one was, I would say, a lot of heavy consumer marketplaces that we were known for. Fund two, we are basically, doing everything from like this room is represented. We have got, in my portfolio itself, a third is consumer, a third is software SaaS, and a third is digital health, which actually has both characteristics of both consumer and software. And then broadly speaking, we have got a big fintech practice. We've got fairly big, I'd say, biopharma, biotech practice. So there's a lot of sectors. There's almost no sector we don't invest in at this point in time. So from where most of the activity, we still I think software we see probably the most activity, but we are very active in consumer and digital health and some of the biopharma areas as well.
Tell me that, all sectors have been kind of humming like crazy, but are there some where you kind of feel like things have played out a little bit from your perspective?
Look, I think the market has been somewhat, it's not like the market has chosen some sectors over others, but there have been areas where I think we are seeing a swing that was being more extreme, and I think it may come back. We were just talking, and this is completely anecdotal, so don't please quote me on this, is on the general fintech side, we had companies that at some point were trading like tech companies, and now the pendulum has swung completely the other side and trading like banks or insurance companies. The answer is probably somewhere in the middle, but we do see a big swing in that part, a bigger swing than we have seen in general software, I think. So that might create opportunities in my mind, because it's clearly they're tech enabled, but they probably should have never traded as complete tech companies.
Okay. So I think this is also a question probably unique to SoftBank, which is I view you all as, in many ways, having driven a fundamental reinvention of this industry with that first Vision Fund. And so what I'm trying to imagine is if you and I are sitting here in 2027 at the Upfront Summit, what will the venture capital industry landscape look like? How much will it look like today? And what might be different? And why do you guys think so?
Well, in 2027, if I'm still sitting, that means I've not become obsolete, which would be actually pretty hard for me to believe. But if I'm sitting, I would say, just like you said, the Vision Fund 1 was a disruptor for the VC industry. I think we're seeing more waves of disruption happening sooner or faster in the VC industry than we've seen, whether it was the Sequoia announcement or others. There's more structures coming into place. Safe to say that by 2027, there'll be at least one other structural change that would have happened. I don't know what that would look like, but it's inconceivable to me that this industry will stay static for the next 5 years. Whether SoftBank does a disruption again, it's possible, or it's something else. I do think there'll be something that fundamentally at least changes the way we think about private markets.
Yeah, Masa seems to be so gifted around thinking about change. Like, I'm just, again, like kind of tapping into his thinking, like how does he talk about the market when he talks to you all about like thinking about changing the fundamentals and having people rethink what they're doing?
Well, rethinking goes on every day. I think one of my favorite stories about Masa is just when I was leaving M12 or Microsoft, I think I won't name the person, but very senior person in Microsoft told me they met Masa, and one of the reasons they're very impressed with him is, it's like if somebody has only seen the ups, then they haven't learned life lessons generally. They're successful, they've only seen the ups. But Masa has sort of seen so many ups and downs, has been counted out so many times, and he's reinvented things more so than I would ever be able to do if I had a couple of more lifetimes. So with him, it's always dynamic. I would say he fundamentally also believes that innovation will continue, and there was no stopping that. How he applies, daily decisions towards that very, very strongly held belief does change, but really doesn't change how we do things. He might come up with something completely left field that none of us ordinary investing folks would have thought of, which is the fun of working with him and sort of picking his brain as to, should we invest here, should we invest there? he won't tell us specifically do 10% here, 20% here, but he will basically at least tell us specifically on don't discount this, and I've seen these markets go up and down, so don't like pay attention as much. So it's good to be in that position where you're not looking at the markets every day, although I end up looking at them every day.
All right. Well, I hope everybody enjoyed this conversation. I know I sure learned a lot. So thank you.
Thank you so much.